Welcome to NASDAQ Trade Talks. I'm Jill Malandrino, Global Markets Reporter at NASDAQ. Joining us for this segment, we have Chris Englebert, Founding Partner and Chief Investment Officer at Englebert Financial Advisors, to discuss how RIAs should manage client expectations in an environment with heightened risk. And Chris, I'm sure that's certainly the understatement of the week here. Before we get into RIA management, I want to talk about the client first and retail investors and how they need to communicate with their advisor about risk and what their expectations are.
Yes, Jill, thanks for having me. We've had a brutal start to the year. January, global markets were down along with fixed income, and it's followed through to February. And I'm sensing a lot of retail investors kind of got complacent because after we made it through 2020, the year of the pandemic, and they saw good returns in their portfolios, those returns were followed up by good returns in 2021. And you literally walked in January 4th, saw the markets roll over. Clients opened their statements, they saw negative numbers. And one of the other issues that happens is people can literally check their portfolio on their phones or on the computer on a daily or hourly basis. And we're just getting this psychology where, the markets are down 10% and they may be down 5%, which although we don't want people to lose money, it's still from a psychological standpoint, kind of like, hey, I made it through the worst part. This was supposedly going to be a good year, and it's not a good year. So it's really all about understanding what's going on in the markets and how your portfolio fits into it, and also communicating with your advisor on how much risk you can stand and realizing there are still risk in investments out there.
Right. And that's such a great point that you make, because when we think about other periods that saw heightened volatility, extended volatility, when we think about it, what we saw through COVID, it really was, 4-6 weeks that we saw that significant move with volatility. But to your point, everyone has trading apps, multiple trading apps, and everyone's on social media, and you just have so much coming at you, and you want that instant gratification or instant answers. And that's kind of not the way the averages work, right, over the longer term. So that's a great point that you make. Now, as an investment advisor, how are you managing clients and teaching them this is how risk works?
Well, we keep coming back, and where I've seen people get into trouble is we try to delineate everybody's money into different buckets of risk. You've got your conservative bucket, your moderate bucket, your aggressive bucket. And where I've seen people get in trouble is they've had too much money in one bucket or another. When I mean that is many times conservative investors have way too much money sitting in a bank savings account making 0% interest. Well, in the inflationary environment that we're in right now, they're actually losing 3, 4, 5% a year due to inflation. By the same token, you have people getting closer to retirement, and they may not have reallocated their 401k in the last 10 years, and they may be 90% equities, and all of a sudden they open up their 401k app and check their 401k and see that they're down, and they're like, wow, am I going to be able to retire? So we constantly talk about how much money you have in your buckets of risk, number one. Number two, we talk about what are you trying to do with this money? So I think we've talked about this last time, but one of the things that we do, for example, when people have 529 plans, I tell them to set the anniversary of their child's 17th birthday. And on the 17th birthday, the kid's going to college in 1 year, move all of that money to a safe option inside the 529 plan. We have a lot of teachers that are retiring this spring, and I was meeting with them in December, and I said, listen, move all of your 403B money to a safe option, because you don't want to be surprised 6 months from now and be down 10%. So it's a conversation about what I call buckets of risk. And, with different volatility, the buckets of risk are going to act differently, and people are beginning to obviously realize that.
Right. And let's take a look at the charts here, right? So starting with the S&P 500, again, February has been a big eye opener for many.
Yeah, no question about it. I mean, we rolled over in January, continued in February. Now, obviously, we have geopolitical, situations literally on the forefront. And I keep telling people it's very difficult to invest in this particular type of environment. I mean, we've seen the 10% correction in the S&P 500. On average, they happen once every 10 years. but we are literally a headline away from either a 5% sell-off or a 10% rally. So I'm trying to have people understand that during these geopolitical events, you really can't do anything because you could make a major mistake in a 24-hour period of time.
Right. And then moving along to the NASDAQ 100, certainly the index that stands out in terms of how it's been digesting what's happening with interest rates and inflation. We can see it's down over 15%. But what's so interesting yesterday, Chris, once we got some certainty in terms of how the US, NATO, EU would be strategizing with sanctions, we saw that index make a reversal that we have not seen in quite some time.
Yes, it was very ripe, very oversold. And you know, one of the things is we've been talking about this the last year, that many of the big indices, the S&P and especially the NASDAQ, have been held up by the big stocks out there, while below the surface, many of the stocks are down 50 to 80%. We think yesterday was probably an important reversal because we saw a lot of those second and third tier NASDAQ stocks catch a bid and catch a bid rapidly. And it's still one of the biggest, most liquid markets in the world out there. And when big money comes back into it, it comes back into it in a vengeance.
And let's go to the Russell 2000, of course. I mean, that index certainly, I mean, it's had a tough time for a number of years, but certainly taking it on the head now.
Yeah, no question about it. We still are fan favorites of small mid-cap stocks this year. I mean, we had a nice breakout at the end of December, only to kind of get caught in a bear trap. And you know, the Russell 2000 went down over 20%. It's trying to reestablish, you know, some kind of traction here. We still think that as money comes out of the big tech stocks and some of the big cap stocks, it's going to find its way into these small mid-cap stocks. But again, when the risk-off trade happens, and the risk-off trade is to buy treasuries and sell stocks, the Russell 2000 takes it on the chin every time.
And moving over to oil, I mean, the run that this particular commodity has had, even with geopolitics aside, I mean, we're talking about inflation here. This is really exasperating the situation.
Yeah, a strong, you know, super spike up. In a former life, I used to trade commodities, and when we'd see a move like this, you know, many people call it a blow off top. You know, it's reached our objective, you know, this year, low 90s. You know, at one point, it touched over $100 a barrel. Rig counts are increasing. There's a lot of strategic situations happening that we believe that oil's reached a target for the year. Would not be surprised to see it come down a quick $20 a barrel, which would actually help alleviate some of the inflation numbers that are we're seeing out there now. All
right, and finally, let's wrap with the 10-year below 2%, but for how long?
Yeah, that's really the question. You know, the inflation trade was out there. You know, this week with the geopolitical climate, it was put on hold. You know, the fear trade came back, buy treasuries, sell stocks, and the 10-year got below 2%. The question is going to be, you know, we've got a big Fed meeting in March. Is the Fed going to raise 25 basis points, 50 basis points? What are they going to end up doing? That's really going to start to affect the long end of the curve. They may be put on hold because of the geopolitical tensions, but right now, the 10-year seems to be stuck at a permanently higher level, right around that 2% level. We got to see, we have to wait until the March Fed meeting to see what the next move is going to be on longer rates.
All right, Chris, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at NASDAQ.